Welcome back to Investing Talk Podcast.
Today we're looking at Baidu.
And man, we are looking at a pretty wild situation here today, August 19th, 2026. Because imagine growing your most cutting-edge business division by 50% year over year. Like, you're dominating the fastest growing sector right now.
In the AI sector.
Yeah. And your reward for this incredible achievement, a 75% collapse in your net income.
It's honestly a phenomenal contradiction. You look at one side of the ledger and you see this explosive, futuristic growth. And then you look at the bottom line and see a company whose financial foundation is structurally fracturing under the weight of that very same growth.
Exactly. So whether you're holding foreign tech stocks or you're just, fascinated by the sheer scale of this global AI arms race, you really need to hear what happens when a legacy tech giant tries to pivot its entire identity.
Before we really tear into the financial filings, we should mention how we're digesting all this heavy data today.
Good point.
We're using StockOracle to help parse these numbers. It's an AI-aided stock research platform.
Right. And just to be super clear up front, it is a research platform. It's not a trading signal service, and it's definitely not a real-time market data feed.
Exactly.
Yeah.
But if you want to follow along and, run your own analysis on Baidu or any other stock, there is a special 14-day trial link right down in the description.
Which is an affiliate link, by the way. So the channel might earn a commission if you use it, but at no extra cost to you.
And just remember, AI insights and valuation estimates, they can be incomplete.
Yeah.
Sometimes they're just plain wrong. Always verify the important information yourself.
For sure. And keep in mind, nothing we say here is financial advice. We are not telling you to buy, sell, or hold Baidu. We're just strictly looking at the data.
So let's get into it.
Yeah.
You really can't understand the stock's current free fall without understanding the fundamental shift in where its money comes from.
Right. The core business model. I mean, historically, Baidu has basically been the Google of China, right?
Yep. Their dominant search engine and the ad revenue attached to it form this incredible cash cow for them.
But now they're living through, the most aggressive version of the innovator's dilemma we've seen in modern tech.
It's a textbook case.
Yeah.
Because from a consumer perspective, AI search and traditional search, they seem kind of like the same product. You ask a question, you get an answer.
Right.
But their monetization models are fundamentally opposed. Traditional search is highly profitable because it operates like a toll booth.
Yeah, you type in a query, Baidu gives you a list of links, and advertisers pay Baidu handsomely to put their links at the very top.
Exactly. The user has to click away to find their answer. But generative AI synthesizes the answer for you directly on the page.
So there's no link to click?
None. The AI gives you the recipe or the code snippet right there. It's a vastly superior experience for the user.
But for Baidu, that completely bypasses their traditional ad toll booth.
They're building a brilliant new AI bullet train, but it's making their highly profitable toll booth completely obsolete.
And the numbers in these SEC filings show the financial wreckage of that transition. Let's look at the bullet train first. Baidu's AI cloud revenue is soaring, up 50% year over year in the second quarter.
Which is massive. In the enterprise software world, growing a division by 50% at that scale, that implies incredible adoption.
Yeah, but then we look at the toll booth. Their core ad revenue is eroding fast. The FY 2025 revenue dropped to $18.458 billion.
And this is a continuation of a multi-year decline from their peak back in 2023.
Right, which leads us to basically the most staggering figure in this entire data dump. Their net income collapsed from $3.255 billion in FY 2024 to just $799 million in FY 2025.
It's brutal. Their trailing 12-month net margins are currently sitting at a microscopic 0.3%.
Wow.
And to understand why that margin just evaporated, we have to look past the loss of ad revenue and look at the physical reality of building AI.
Because it's not just code, it's like heavy industrial infrastructure. The data shows Baidu's capital expenditure, their CapEx, rose to $1.726 billion in FY 2025. But what are they actually buying with $1.7 billion?
It goes straight into the physical foundation of the AI arms race. They are buying tens of thousands of advanced processing chips. They're securing massive tracts of land for new data centers, upgrading specialized cooling systems so those servers don't melt, and securing dedicated power grids.
So they're front-loading a decade's worth of infrastructure costs before a single dollar of profit is realized.
Exactly. Building an AI infrastructure is closer to building a nationwide electrical grid than launching an app.
Which totally explains the cash flow statement. Their operating cash flow turned aggressively negative it dropped to negative $431 million in FY 2025.
And just for context, back in 2023, that number was a positive $5.1 billion.
That is a massive swing.
It is. If we calculate a proxy for free cash flow by subtracting that $1.7 billion capex from the negative $431 million operating cash flow,
Yeah.
Baidu essentially burned roughly $2.1 billion in FY 2025.
Over $2 billion, so this isn't a temporary slump.
No, it's a foundational paradigm shift. The AI transition is consuming cash far faster than it's delivering returns.
So if they are fundamentally redesigning the architecture of their business and burning billions to do it, how is Wall Street digesting that?
Well, the market hates uncertainty.
Clearly. Following their missed Q2 estimates, the stock took a 12.7% hit in a single day, closed at $90.87.
Which leaves it almost 45% below its 52-week high.
Yeah. And looking at the technicals, the price is trading below its 20-day, 50-day, and 200-day simple moving averages.
Those moving averages are critical benchmarks. When a stock breaks below the 200-day average, it signals to algorithmic trading systems that the long-term trend has reversed.
It triggers automated selling.
Exactly. It creates a self-fulfilling cycle of downward pressure. The stock just becomes radioactive to major portfolio managers.
And the sentiment data backs that up. It's categorized as overwhelmingly bearish to cautiously neutral, with a huge wave of analyst downgrades. Like Zacks went all the way to a strong sell. But I have to play devil's advocate here for a second. Because if I'm an investor who believes AI is the future, I see some conflicting data points.
Like what?
Specifically, the RSI 14, the Relative Strength Index, it's sitting at 27.24. Anything below 30 is deep in oversold territory.
The mechanical indicator is definitely flashing oversold, meaning the velocity of the sell-off was statistically extreme.
Right. And then you combine that with the valuation multiple, the data notes Baidu is now trading at roughly an 11.3 PE ratio.
Yeah.
So if I have a company growing its AI cloud at 50%, the stock is technically oversold and it's trading at an 11.3 multiple. Shouldn't a savvy investor be stepping in to buy the drop?
That is the classic value investing thesis.
Mm-hmm.
But applying a historical PE multiple to a company undergoing a structural business shift is incredibly dangerous.
Because the E in that price-to-earnings ratio is actively collapsing.
Exactly that. The multiple looks cheap at 11.3x because it's looking backward at earnings that were supported by the traditional search ad revenue.
Which is dying.
Right. Furthermore, the 26-week return is down over 37%. In an environment where free cash flow has swung to a negative $2.1 billion, an oversold RSI doesn't mean the stock has found a floor.
It just means the elevator is dropping really fast.
Yes, buying into that momentum just because a spreadsheet says it's historically cheap is a fantastic way to destroy your capital.
Okay, so the internal fundamentals are heavily strained, and the technical momentum is fiercely negative. But Baidu doesn't exist in a vacuum.
No, it operates as a major tech champion within China.
Which means we have to layer on a massive geopolitical component here. The macro shadow over this stock seems just as heavy as the cash flow deficit.
In many ways, the geopolitical environment dictates the ceiling for how high this stock can ever go, honestly.
We see that with credit agencies. Fitch recently downgraded Baidu to an A rating with a stable outlook.
But the more pressing issue involves U.S. defense-related restrictions and severe regulatory scrutiny over Chinese AI models.
Yeah, governments are viewing these foundation models as critical infrastructure now. Which brings us to a specific headline risk in our research today. And just to be clear to the listener, we are reporting this strictly from an impartial market mechanics perspective. We are not endorsing any political viewpoint or side here.
Right, just looking at the risk factors as documented.
Exactly. So the research mentions recent reports regarding Trump-backed World Liberty Financial partnering with a platform that offers Chinese AI models. And some of these specific models have been flagged by the U.S. government.
Right, and how institutional money prices in that level of geopolitical tension is by applying a heavy permanent discount to the company's valuation, a risk premium.
So even if the math on the balance sheet looks good, investors demand a much higher potential return just to compensate for the fact that a government regulation could upend the business overnight.
That is the core of it. Think about the total addressable market, or TAM.
Okay.
Let's assume Baidu's massive capex pays off, and they develop the best AI model on the market. If international trade blocks restrict its usage or penalize platforms that integrate with it, Baidu's TAM shrinks dramatically.
So their runway for growth is artificially capped by borders and sanctions, not by the quality of their code.
And when growth is capped by unpredictable regulatory forces, investors just refuse to pay a premium multiple.
Wow. Okay, so we have collapsing net margins, an obsolete search toll booth, a 12% technical plunge, and international regulatory dread.
It's an overwhelming amount of conflicting, highly volatile information.
How does a modern investor even synthesize all of this? I mean, this is where AI-aided research platforms like StockOracle come in, right?
Yes, it's a profound shift in how retail and institutional investors manage information overload. The sheer volume of SEC filings and geopolitical news is just beyond human processing capability on a real-time basis.
Our data shows StockOracle ingests standardized financial information across more than 15,700 U.S. stocks and OTC stocks, too.
Right. It generates a quantitative thesis.
But I want to dig into how it actually does that. Like, the platform has a feature called OracleValue, which calculates intrinsic value estimates. How is an algorithm computing the true worth of a chaotic company like Baidu?
Well, platforms like that typically rely on established financial frameworks, like the discounted cash flow or DCF model.
But wait, we just spent the first half of this discussion establishing that Baidu's cash flow is actively falling off a cliff, going from positive 5 billion to negative 431 million.
Yeah.
How can an algorithm accurately project future cash flows when the foundational business model is cannibalizing itself?
That is the exact limitation of relying purely on the algorithm. And it's why we have to explain that AI insights can be incomplete or simply wrong.
Because an algorithm might look at the 50% growth in the cloud division and mathematically project that out over 10 years.
Exactly. It might simultaneously look at the 11.3 PE ratio and conclude the stock is deeply undervalued. But the algorithm struggles to quantify the qualitative context.
It can't map out the human fear of a geopolitical sanction or exactly when users will stop clicking traditional search links.
Right. They also use features like AI moat analysis to judge competitive advantage. But again, how does software calculate the durability of a moat when international governments are actively changing the rules?
It also brings up a very practical limitation regarding data latency. The data feeding these AI platforms is often delayed by 15 minutes for U.S.-listed stocks.
And for OTC stocks, the data is only updated at the end of the day.
Right. So a 15-minute delay means you are entirely blind to institutional order flow as it happens. If Baidu drops 12% in an afternoon, relying on data that is 15 minutes old is like driving down a highway using a map from yesterday.
You're going to crash, which is exactly why these platforms do not execute trades for you.
Yeah, they aren't high-frequency trading terminals.
They're organizational tools. They build custom watch lists and visualize portfolio risk. They can stack the negative cash flow next to the cloud growth, but the final synthesis, that remains a deeply subjective human judgment.
You cannot outsource your critical thinking.
Never.
So, relying on our human synthesis of all this data, what is the final verdict on Baidu's current position?
Based on the fundamental cash burn, the broken technical chart, the deteriorating market sentiment, and the heavy geopolitical risk premium.
Yeah.
The overarching assessment provided is a rating 3, which is a bearish stance.
A bearish rating 3. That is a heavy label for a company at the forefront of the AI revolution.
It reflects the immediate reality over the theoretical future. The near-term outlook is just crushed by the erosion of the advertising cash cow.
Until they prove they can navigate the innovator's dilemma without bankrupting their operating cash flow, the market is going to remain deeply skeptical.
Definitely.
Now, for those keeping a close watch on the ticker, there is an immediate catalyst approaching.
Right, the upcoming extraordinary general meeting on August 26, 2026.
Management will be seeking new share issuance and buyback mandates.
A massive buyback could theoretically provide an artificial floor for the stock price. But any market reaction is purely speculative until capital is actually deployed.
Because a share buyback might stabilize the chart temporarily, but it does absolutely nothing to fix the negative $2.1 billion free cash flow deficit.
The underlying architecture still needs to be rebuilt.
It seems like they've built the world's fastest bullet train, but they're currently burning the tracks behind them just to keep the engine running.
That's a great way to put it. Oh, and before we wrap up, just a final reminder about StockOracle.
Yes, the 14-day trial link is in the description below. It is an affiliate link, so we might earn a commission.
It's a powerful AI-aided research tool, but again, not a trading signal. Always verify your own information.
Absolutely. Which leaves me with a final lingering thought for you to mull over as you look at your own investments.
Let's hear it.
We've spent this whole time detailing how a massive tech giant like Baidu is burning billions of dollars, destroying its own profit margins, and terrifying investors just to build the next generation of artificial intelligence.
Right.
If the massive corporations actually creating this technology are struggling this profoundly to make the financial math work,
Yeah.
how much blind faith should we really be placing in the AI algorithms we use to manage our own portfolios?
That is a very unsettling question to end on.
Something to think about. We'll see you next time on Investing Talk Podcast.